Good afternoon. This is Betty Meredith, President of the Retirement Resource Center, a retirement education and training company for professionals, clients, and consumers. And I'm happy to be your host today for this webinar on incorporating the housing asset in retirement planning with Shelley Giordano of Enterprise Integration with Mutual of Omaha Mortgage. She is also the founder of the Academy for Home Equity and Financial Planning at the University of Illinois. For middle-income retirees, home equity is the largest asset they have after the present value of their Social Security and pension benefits. And working in retirement is third, their human capital, and their retirement savings that we've all worked hard to help them build is actually fourth. In a time when lifetime income sources such as pensions and Social Security benefits are declining, accessing home equity will become more important as people live longer and face increasing healthcare costs. Reverse mortgages offer a mechanism for tapping home equity for retirees to address these needs and stay in their home. Because of key changes made to reverse mortgages by the Federal Housing Administration to the Home Equity Conversion Mortgage Program, the safety and functionality of accessing home equity now goes beyond supplementing retirement income. In addition, several large broker-dealers have also recently removed their sanctions against discussing the mobilization of the housing asset to aid retirement resilience. Shelley Giordano is the author of What's the Deal with Reverse Mortgages, and the second edition was printed in 2019. It is the first book to analyze the role of the housing asset in retirement income planning. And in 2012, Shelley co-founded with Tori Larson, the president of Mutual of Omaha Mortgage, the Funding Longevity Task Force, now known as the Academy of Home Equity and Financial Planning at the University of Illinois. Shelley also co-chaired the Housing Wealth in Retirement Symposium in Washington, D.C., the first event to draw on the combined expertise of HECM, home equity conversion mortgage industry leaders, NGOs, regulatory agencies, financial services professionals, and academicians. She also directs enterprise integration at Mutual of Omaha Mortgage. There, she mentors an elite group of loan officers whose focus is on helping the financial planning community integrate the housing asset into the retirement planning process. She is also tasked with incorporating reverse mortgages into the advisory arm of Mutual of Omaha, and she frequently speaks at industry events, financial services conferences, and participates in radio and television broadcasts. And she's been published in a boatload of areas, Benefits Magazine, RMA Journal, the Retirement Income Journal, and others. So thank you, Shelley, so much for being here with us today. And I'll now turn it over to you.
Thank you, Betty. It is a pleasure to be here. Do the learning objectives first. So you will learn, number one, what share of total wealth is represented by the housing asset, how reverse mortgages have evolved to meet your client's need for safety and sustainability, strategies that amplify coordination of retirement assets, and then we'll take you at the end out to a website that will show you how to calculate the monetization of the housing out very, very, very quickly, you know, even if you're just sitting there with your clients. So why the house? Well, the reason that the house has come into focus for retirement income planning professionals is that it represents such an enormous proportion of the average American's net worth. It's estimated by the U.S. Census Bureau that over 2/3 of the Americans' net worth retirees' net worth is concentrated in his home. So in this slide, I'd like to point out that the strategies that we're going to be discussing come from the collective wisdom of retirement planning experts. This isn't information that's coming to you via a mortgage company. This comes from the collective wisdom of mathematicians, actuaries, pension lawyers, academicians, and practitioners. And many of them are members of our Academy for Home Equity and Financial Planning, which Betty Meredith is a member as well. And you see a picture of a few of us here. That's me kind of in the middle. Barry Sachs, PhD, and tax and pension lawyer. Wade Pfau, of course, the professor of retirement income at the American College, and Jamie Hopkins. So rest assured that the information you're going to see here has been vetted by the best in your field. I really enjoy providing this slide from the get-go so that we can just tell you what the pros and cons of a reverse mortgage are. So, so let's start with the things that are not so attractive about a reverse mortgage. And the first one is that it's going to cost your client some equity because the product is FHA insured. So there are premiums, both upfront and ongoing, that are going to FHA, the Federal Housing Administration, to provide the safeguards that are available in the reverse mortgage, which we'll discuss later. But there's no question about it. Sometimes there's quite a sticker shock when your clients see that setting up a reverse mortgage is going to cost them some of their equity. It's not upfront cash that they need to come up with, but there will be a depletion in their equity. And the second negative in a reverse mortgage is that it involves compound interest assessment. So what that means is, because there are no monthly payments and a client isn't making a payment on the interest is going to be tacked onto the loan balance. And so the loan balance will be greater the following month, and the interest then will be assessed on that greater loan balance. So it is possible for the client to make payments on the reverse mortgage, but most people don't do that. So compound interest, as we know, is just a beautiful thing when it's working for you, and not such an attractive thing when it's working against your equity. All right, so now let's take a look at the pros, however. First of all, because of that FHA insurance, the reverse mortgage is a non-recourse loan. And that means that the client will never owe more than the value of the house, the client or his estate. All right, number two, as I mentioned earlier, the reverse mortgage is incredibly flexible. The client may choose to pay the interest, make payments on the interest and the principal that they've drawn, make no payments, make payments, as Dr. Wade Pfau suggests, in good years when the market is up and the retirement assets are healthy. Go ahead and make payments, but don't make any payments on your reverse mortgage when it would stress the portfolio. Totally up to the client. A lot of people don't realize that a reverse mortgage cannot be canceled, frozen, or reduced, and that's even true if it's in a line of credit structure. So one of the problems with a HELOC, as we know, is just when the banks just when the client needs liquidity, the banks do too, and oftentimes they cancel and freeze those HELOCs. Absolutely cannot happen in a reverse mortgage. No foreclosure possible for missing payments. No payments are ever due, so you can't be foreclosed on because you've missed a payment. And then another aspect of reverse mortgages that is not very well understood is that credit capacity grows with age. So let's just kind of talk conceptually about what is a reverse mortgage. So a reverse mortgage is a mortgage, and the amount of money that the client is eligible for obviously is based on the home value. So the home provides the dollars, but it also serves as the sole collateral. We're not looking at the client to ever make a payment from any other resources. The house is going to provide the repayment. And this loan is non-recourse. And in order to make it non-recourse, actuarial principles need to apply. So the amount of money that the client is eligible for is based on their life expectancy. So if the house is going to pay the loan back, if you're younger, the assumption is you're going to be in the house for a longer period of time, so you're going to be eligible up front for less money. If you're older, the assumption is you're going to be in the house for a shorter period of time, so you're eligible for more money. And then again, talking about the sort of the actuarial or insurance aspect of a reverse mortgage, you get growth in your borrowing power as you age. So just keep that idea in your mind that credit capacity, growth in borrowing power gets greater as you age.